How do banking collapses affect the global economy? Breaking news in the financial world. The question on many people's minds right now is, how do banking collapses affect the global economy? With recent events shaking markets, understanding this topic is more important than ever. Let's break it down to see what is happening and why it matters. Banking collapses can trigger widespread economic disruption both domestically and internationally. When a major bank fails, it leads to a loss of confidence among depositors, investors, and other financial institutions. This loss of confidence can cause a chain reaction of liquidity shortages and credit tightening across the financial system. As a result, businesses and consumers may find it harder to obtain loans, slowing economic growth and potentially pushing economies into recession. Historically, the collapse of Lehman Brothers in 2008 serves as a key example. This single bank failure escalated into a global financial crisis. Lehman's failure caused panic in global markets, froze credit flows, and led to a severe worldwide recession. Banks became unwilling to lend to each other or to businesses, demonstrating how interconnected banks are across borders. Banking collapses also affect government finances and monetary policy. Central banks may need to intervene by providing emergency liquidity or lowering interest rates to stabilize markets. However, aggressive monetary tightening to control inflation can increase borrowing costs and strain banks. This situation can raise the risk of further failures. Additionally, central banks' balance sheets can suffer from losses on assets, complicating their ability to support the economy. Regulatory changes after the 2008 crisis aimed to make banks more resilient. These changes required higher capital buffers to protect against losses. Yet, proposals to relax these rules, such as exempting United States Treasuries from risk-weight calculations, raise concerns about increasing systemic risk. Insufficient safeguards could trigger another crisis. Banking collapses disrupt credit availability, shake market confidence, and can lead to recessions that spread globally. The interconnected nature of modern finance means that problems in one institution can quickly affect others. Policymakers face the challenge of balancing inflation control with financial stability. The history of financial crises highlights the importance of strong regulation and cautious monetary policy to prevent widespread economic harm. As we witness ongoing developments in the banking sector, staying informed is essential. Understanding how banking collapses affect the global economy can help individuals and businesses navigate these uncertain times.